Now let's talk about covered call. One thing that is important to remember is a covered call is a long a stock
Yeah.
plus sell or maybe short.
A call.
But when I'm long a stock, what is the need of selling a call? I don't understand this.
Hmm.
Unnecessary. Either
Yeah.
I'm playing with options, good for me.
Yeah.
Either I'm playing with the stocks, okay, it's fine for me. But
Yeah.
I'm long a stock and I'm selling a call.
Yeah.
Why? What do you think would be the motivation?
Mm.
Acha, theek hai. I'll just help you out to understand.
Yeah.
Why would somebody sell a call?
To receive some premium.
Think about this. Selling a call, selling a call
Unlimited.
means you have an
Unlimited.
unlimited loss.
Yeah.
Why would somebody do that?
Yeah. Hmm.
There has to be bigger motivation, right?
Yeah. Not sure.
Okay. Again, let's talk about NBCC.
Hmm.
By the way, I don't have a position in NBC. I just took some example.
Yeah.
So let's say you have NBC stock, you are long NBCC.
Hmm.
Current price is 100 rupees.
Yeah.
And you have been following this stock from quite a few months, or maybe
Okay.
quite a few years now. You know its daily potential. How
Yeah.
how far can it go on a good day, on a bad day, what's the
Yeah.
volatility, etc. So you know that in a week's time, the maximum volatility is 10%.
Okay.
I'm not trying to use some technical jargon on volatility, standard deviation. No, just trying to tell you a simple thing that you know from experience that the maximum that it could go is 110 or maybe
Yeah.
90.
Yeah.
But you want to earn some money. You
Yeah.
went to the market and you saw that there is a law. There is a way that you can write a call as good as selling a call
Yeah.
for a strike price of 120, and the premium that is being given to you is 4 rupees.
Yeah. Yeah.
Is that a bad deal?
It's not. Yeah. It's a good deal because it
It's a
won't
good
go
deal,
above.
right?
Yeah.
Because people who don't know might still think that it might cross 120 and then they can make money. But
Yeah.
you in yourself would know that it would not go again. Everything is a probability, but then you're pretty sure that it will
Yeah.
not go up to 120, and then this is a easy money that you can earn.
Hmm. 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 Hmm.
Because you're selling a call, you are making the money.
Hmm.
So if you are thinking that okay, I think that it will not go 120, or maybe the volatility is not too high,
Yeah.
right? So you can easily make money just by earning 4 rupees without doing anything.
Yeah.
Good enough motivation?
Yep.
Okay. Let's talk about another motivation. You have 1,000 shares of NBCC, right? And obviously the price is again 100.
Mm-hmm.
And you think that your actually buying price was 70 only, actual buying price. So you are anyways pretty satisfied with 100 rupees. So even if you go to the market and sell those, let's say you want to sell only half of the position. If you think that you want to sell your 500 shares worth rupees 100, that's a good money, and you're happy with
Hmm. Hmm.
that, right?
Yeah.
Since you are already in your mind, since in your mind you already are trying to sell the stocks at 100, I would say, how about you sell a call with the exercise price of 101,
Okay.
or maybe 100 itself. I don't mind. Right? The benefit is twofold. First of all, if the stock price is 100 rupees, for a strike price of 100 or 101, the premiums will be huge.
Mm.
Right? You
Mm.
understand why?
Yeah, yeah.
Because the the probability of getting it to
Yes.
101 or 102 is too high, so the premiums are too high. So when you already have in your mind that you want to sell your position, you want to reduce your position, and if you sell a call, let's say at a
Mm.
strike price of 100 only, which is at the money,
Mm.
how about that you earn extra premium of 10 rupees? You were anyways going to sell the stock at 100 rupees, and now you
Yeah.
got 110 for free.
Right.
There is no loss because you were anyways going to sell it at 100.
Yeah.
Make sense?
Makes sense.
Okay. And lastly, you want to sell your whole position.
Mm.
Maybe either you want to reduce the position or you want to sell the whole position. You could get a question somewhere on these lines, that why would somebody buy a covered call, right? So the options, I mean, the motivations are, first that you would know is that you want to, for yield enhancement,
Mm.
right? Maybe to reduce a position,
Yeah.
and
Yeah.
third, maybe target price realization.
How is it reducing a position? The second one?
Yeah, it's not reducing a position, but from 1,000, you anyways wanted to make it 500,
Yeah. Okay.
right? So you just sold those 500 at a premium. I
Got
mean,
it.
you sold the call, and obviously somebody is going to execute the call when the price goes higher, right? So that way you can earn some
Mhm.
extra. At the same time, you also reduced your position the way you wanted.
Mm.
Make sense?
Makes sense.
Okay. Let's just also quickly look at the payoffs, although we understand how the payoffs would look like for a covered call. Yeah. Without the call, our payoffs would have looked like something like this.
Yeah.
It's a simple long stock
Yeah.
payoff. But then when you are going to sell a call, obviously at some desired price,
Yeah.
you are truncating your profits.
You are truncating the upside.
The profits,
Yeah.
right? Because
Yeah.
somebody is going to execute that. So
Yeah. Yeah.
your profits will be truncated. So a covered call payoff would look something like this.
Mm. Mm.
Make sense?
Yeah.
Let's talk about protective put.
Okay.
In a protective put, you are long a stock plus you are long a put.
Okay.
Why would you do that?
You want to basically protect your downside, restrict it.
Simple, right? That I
Yeah.
want to protect my downside,
Yeah.
right? So if it is, this is stock this, I would pay a lot of money, right? Because this, when I buy this, I paid some money.
Yeah.
And even in put option, I'm long the put, so I'm paying the premium again.
Yeah.
So that way I'm spending a lot of money, but at least that way I'm securing my downside
Yeah.
completely. Uh, Again, how the payoffs would look like. This is of a regular stock.
Yes, correct.
And how would I protect my downside?
Mm, basically, at a
My
certain
long.
price. Hello, can you hear me?
Yeah, I can hear you very well.
Yeah, okay, got it. So you'll intersect over there. Okay.
So this is my long put.
Yes,
This is my long stock,
yes,
right? So this just offsets.
yes.
So effectively, this is as good as a longer call, right?
Right, right.
One more thing is sometimes it's easy to understand, although I have covered that already,
Hmm.
but I just want to reiterate one more time. When it comes to covered call,
Mm-hmm.
what could be the maximum profit so that we have everything on one page?
So,
How much could
yeah,
be the maximum?
the maximum profit would be just thinking one sec. Maximum profit. Yeah, I I understand the graph, but I just don't I don't
Okay,
know what.
I'll help you out with that.
Yeah,
So, what did we say for a covered call? For a
it's
covered call, we do
long.
a longer
Your
stock
yeah,
and then we are shorter
shorter
call.
call.
So leave this part for now.
Yeah,
You bought something at 70,
yeah,
you sold something at 120.
yeah.
What's your profit?
50.
So far, so good.
Yeah,
Now, you actually sold a call for a strike price of 110, which means when the price goes above 110, somebody else is going to execute the trade and you will have to, your profit will be truncated. Remember this? The graph was something like this.
correct, correct, correct.
So the maximum profit that you would get is not effectively ST now,
Yeah,
it is going to be X. Do you agree?
it's going to be X.
Yeah, the strike price.
Hmm. 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 Hmm.
You know why? Because the moment it becomes 111,
Hmm.
for the person who is long the call, you are short the call, right?
Yeah, he will
Someone
execute.
who someone who's long the call, he has a right to execute and he will execute, obviously.
Yeah.
So post 110, he will earn the money. You will not earn the money. So the maximum profit will get truncated. I'm referring to this part now,
Yes. Yes.
right? So your
Yeah.
maximum profit is 110, not the
Got it.
profit, but you will not make money after
Yeah.
110.
Yeah. Yeah. Got it.
So can I say that the profit, maximum profit could be X minus your S0, which was 120 minus 70 before, but now it is 110 minus 70,
Hmm. Yeah, that's the maximum.
right? That's the max that you could get. And obviously, when you have sold a call, you must have earned some premium,
Yeah. 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 Yeah.
right? So I say that in case of a covered call, the maximum profit could ever be X minus S0. I'm putting it S0, okay, not ST. plus C.
Yeah.
Make sense?
Yeah.
Okay. How about the maximum loss?
Maximum loss is equal to minus S0, which is how much you've paid for,
What is minus is 0?
how much you've paid for
Oh,
the,
yes. So the stock price, whatever you have paid initially,
yeah,
which is 70 over here.
yeah,
So if this becomes 0, your maximum loss is 70.
yeah,
But you have sold a call, so you must have got some premium.
right, right,
So the loss would be minimized
yeah,
by the call option
yeah,
that you have. Actually, this is minus 70 plus call,
yeah,
right? And when I'm using the word loss, then I can write 70 minus call. Can I write?
70 minus call,
70
yeah,
is using the word loss,
yeah, yeah,
right? So can I say that this is actually S0 minus C?
yeah,
Are we good?
yeah.
If you're not sure, do ask me again and again, okay?
No, no, no. I got
All right. How about in terms of protective put,
yeah,
what do you think would be the maximum loss, maximum profit?
that's unlimited.
Maximum profit is unlimited, perfect. How much will be the maximum loss?
Maximum loss will be basically your
The protective put, we are long a stock and we are long a put.
yeah, it will be just give me a second. It will be the strike price of the put minus the price at which you bought the stock minus the put premium.
Minus the put premium. Okay. So the maximum loss would be you are long a stock,
Yeah,
so the maximum loss could be as 0,
yeah,
but you are long a put as well.
yeah,
So think about this. For a long put, by your profit though is unlimited because of
yeah.
this. What is the payoff of a long put?
It
X minus S0? Actually, S0 minus X. Actually, in terms of loss,
hmm, correct, correct.
right?
Yeah,
And then you paid the premium,
yes.
right? So another money that you have paid. It's just a change of the signs, but what you have written is the same as what I have written.
Yeah, yeah,
Think about this, right? S and P have the same signs, and X
yeah.
is the opposite. But in terms of loss, so I'm not saying minus 3 profit. I'm calling it
Hmm.
as a 3 rupees loss. That's about it.
Yeah, yeah, yeah,
Right? Are we good?
yeah.